Good day, fellow investors. A few of you asked my opinion about Tyson Foods. The stock is down 50% from its peak, but it has had its ups and downs over the past. But you can see it compounds over time. So now we have to see whether already here it is a good buy for long term cycle swings, and then you can maybe make a few 100% when it goes up, or it is a low risk cyclical. Now, let's start standard stock analysis. Thank you for your comments. Tyson Food situation. We already discussed the stock. Let's go into the business. The company is the second world largest processor and marketer of chicken, beef, and pork, and it annually exports the largest percentage of beef out of the United States. Here it says most of the things you need to know about this investment situation, because there are a few things that are important when it comes to meat. In the last quarters, input prices went up. However, you cannot just transfer those input prices to the customer because there are many substitute products. Some days you can buy broccoli instead of something like that. So, depending on the price, there is plus and minus demand. There is also the cost of production where the margins go up and down. When all of those things combine, and especially if global prices, as it is an exporter, those are just commodities. Meat is just a commodity. If you can produce it cheaper, better, great. If Argentina can produce it cheaper, then it's better for them in that point in time. So there are a lot of parts that affect the meat market mechanics, and if you want to invest in that, you need to understand those. You need to understand what the market thinks about those, and then when the market doesn't think good about those, when it thinks short term, you buy, and then on the long term you make a good return on that upward swing, because demand for meat, yes, is pretty stable, expected to grow at 7% per year, thus a growing trend. There are a lot of investment, but at some point, if it isn't profitable as it is now, those investments are lower, then we have profitable times, less profitable times, and that's normal in commodity businesses and cycles. So the key question for investing is, will margins improve? At some point, very likely, but not yet. If you look at their predictions, indications of margins around zero, only the prepared foods that are usually higher margins, that's a different business, those are unchanged, but that will not be enough to have positive cash flows, and the capital expenditures on the previous year's high margins and investments opportunities are extremely high. This is why the stock is going down. They are investing heavily into a bad market, which means the cash flows are delayed, and who knows when. And that's something the market doesn't like, and that's why you see the 50% decline. The answer to that will be in knowing the industry cycle and watching the industry cycle. If you listen to Peter Lynch, when it comes to analyzing and investing in cyclicals, wait for things to start improving. Let the stock go up a little bit when the first things start improving. But when you see that momentum in earnings going up, you can then take the best risk and reward situation is to take that start a little bit later than the start of the upward trend before the peak. And you make your 30, 40, 50% with the buy, and that would be the best situation there. Let's take a look at the financials. Oh, by the way, I think there is a 20, 40% discount on Ticker where I check all my financials. Click in the link in the description below if you are interested. Balance sheet, let's just check it quickly. There is goodwill from acquisitions, from growth. There is some long-term debt. They have worked on paying it down, but this is still 8 billion. And then the key question is not that much here. The equity that is 19 billion minus 10 billion for the acquisitions, it's meat. For me, it's a commodity, not really a branding situation. 10 billion in equity, the plants and everything, that's where the value is. So another 50% possibly down, but that would give you a equity margin of safety. And if we look at what is going on now, here you have the answer. The last 12 months, thus the last 6 months, already gross margins down. Likely when you eliminate the 6 months of the last fiscal year, this will be at zero, which means net income going from 3 billion to likely zero as they predicted. Cash flows also with 2.3 billion of investments will likely also be negative. Maybe they will have to take more debt with the debt they already have. It can look uglier, and nobody wants to touch this when it's looking uglier because everyone wants to make money immediately and invest when the situation improves. As I said, Peter Lynch strategy. So how to value this? They can make 3 billion in a good year, likely with the growth and everything they will likely make 4 billion in the next good year in the cycle. 4 billion compared to what is 20 billion the market cap, that's a 20% return, which means that if that happens and when that happens, you have a double with the stock if they survive by then. They should, why not? So there is plenty of liquidity, but that is the risk and reward. But the key thing here is, I think, of course, you have to understand the market mechanics, regulations, input prices, commodities, all looks like a normal cycle. Book value would be the margin of safety, 20% below book value can get cheaper, but how much cheaper? And why it looks bad now? Because there is huge investment cycle, highest capex now into a bad market. Everyone is scared when such a situation happens, makes the cycle downturn longer. The huge investments on high profits in the last 5 years will make the mid-cycle downturn longer. And the question for investors is when? When will I get my returns if I invest now? If I don't get my returns in the next year or two, who is going to sit in on this dud for the next 2 years? And that explains the stock price. I personally am not going to look deeper here because even if it might be a good investment, it's just a sector that I now don't have the will nor the time, nor am I attracted to learn all the mechanics of it. I have my commodity players, my this, my that, my other food stocks where I'm more comfortable watching and working on that. So it's you cannot know everything. That's my only answer here. I hope you make money on it if you are invested or looking, but the key message here is understand the mechanics of the cycle, and you have to understand it so well to make money. You have to understand it better than the market. So analysts usually look 1-2 years ahead. So you need to understand the cycle and the actions 5 years ahead. That's the best value added I can give you for Tyson Foods. Thanks for watching. I'll see you in the next video.